This is boring, but your portfolio will beat the market. In this video, I want to discuss how a boring portfolio can outperform the market and how investing is designed to be boring. If you really want to create alpha, to create an outperformance, to build long-term wealth, your portfolio has to be boring. If you chase after the hype, you will make many mistakes and it will be a drag on your performance. In this video, I want to explain what I think why a portfolio should be boring if you really want to outperform the market. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now with boring companies, and I have achieved a performance of 25% per year with boring companies. So I want my portfolio to be boring because I want to continue to make 25% per year. Okay, the first point, this is boring, but your portfolio will beat the market. If your portfolio feels exciting, you're probably doing it wrong. The markets reward discipline, not dopamine. In this market, you have a lot of information. You have plenty of stocks that go up meaningfully, plenty of stocks that crash and then rebound. You have turnaround plays. You have Trump that is tweeting a lot, so maybe you want to trade around the tweets from the president of the United States. Yes, it will give you a lot of dopamine, and it will give you the illusion that the stock market is a casino. Now with Robinhood and online brokers, you have a lot of colors, you have a lot of gameplay, you have this gamification of the stock market, minimal friction, you have minimal fees, so it can be very trendy and amusing to very funny to play the market. And this is a sentence I hate to say, it's a sentence I hate to listen to, playing the market. And Peter Lynch doesn't like this quote too, by the way. Most investors underperform not because of skills, but because of behavior. I told you about all the temptations you could have in this market. The goal and the reason why I am outperforming the market is because of discipline. Discipline because of valuation, discipline because you don't go outside your circle of competence, discipline because I have a concentrated portfolio, you don't chase after the hype, FOMO, okay? By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second point, why boring equals alpha? Long-term outperformance comes from 1. Owning high-quality businesses for decades. 2. Ignoring all the noise. 3. Rebalancing rationally. Most hedge funds underperform the S&P 500, which is true even for very recent years, 2023, 24, 25, you had the lowest percentage of fund managers that were beating the index, because now the index is so concentrated towards the Magnificent Seven, it's almost impossible to beat the market. So far, I am doing it, so very happy. Let's celebrate a little bit. But yeah, it's very hard to outperform the market, and hedge funds have this FOMO to trade the market, to play with the market. The goal of a hedge fund, in case you don't know, is to sound smart. So you can lure your clients to put more capital in your fund, so you can get some fees out of them. And if you get some fees, you can have some good money, good salary, you can buy a new house. So yeah, of course you want to be appealing, you want to be sexy. This is not my goal at all, because I don't run a fund, so I can do whatever I want with my portfolio. The goal of my portfolio is not to be sexy or exciting. No, it's to be boring, to outperform the market. Pretty easy, but you have two philosophies. Please don't compare yourself to hedge funds, because you don't have the same goals at all. You are a retail investor. Your goal is to play safe and compound your wealth and outperform the market, okay? Hedge funds need to do the marketing, the packaging, to look good in suits, so you can talk to clients, shake good hands, and be appealing, raise funds, and get your fees. The more AUM, assets under management, you have, the better your life, because the higher your fees. If you have huge fees, you can buy a new mansion, okay? So this is not the same goal. Please don't compare yourself to hedge funds. And this is also the reason why most hedge funds underperformed the S&P 500. And Buffett crushed both with boring stuff. Yeah, for his long career, Warren Buffett outperformed the S&P 500 and hedge fund managers for so many years, by such a wide gap. Since he took over Berkshire Hathaway, Warren Buffett compounded its shareholder returns for at what, 20% per year, 19.9% per year. Yeah, it's spectacular what he has done, and this is the reason he's so famous. He invested in boring companies. He didn't invest in sexy giants. So what boring actually means, if you don't know what a boring portfolio looks like, this is for you. You buy company you understand, that you understand. So companies that are inside your circle of competence, meaning you know what they sell. A good test to see if something is inside your circle of competence is, can you explain the investment idea to a child in 1 minute? If you can't explain in simple words what the business does, how it makes money, what are their clients, what are the growth opportunities, if you can't explain in 1 minute with simple words to a child, it means you don't understand. You don't understand the business. So yeah, you can make this exercise for your whole portfolio. Okay, so that was for the first point. You buy companies you understand. Pretty boring, pretty simple, but it works. Second point, holding through volatility. You will have volatility in this market. You will have ups, you will have downs. You have a US president that is very bullish for the stock market. So you may have the biggest bubble of all time. You can have a lot of debt in this market. You will have a lot of volatility and drama if you invest in US equities. Can you hold? If you can hold and sleep well at night, well, it's very boring, but it works. 3, spending more time reading reports than trading tickers. I see a lot of people on YouTube or Twitter, they judge whether an investment idea is good or not, depending if the stock is up or not for the past 6 months. So you buy something, and after 6 months, the price doubles, and you say, oh, look how smart I am. Be careful of these people. Be careful because if the stock goes down, they will delete their post, so they will only keep the winners. I've seen this happen too many times. So please be careful, my audience. Please be careful what you see on the internet. You want to look at boring stuff. Don't look at the stock prices, but look at the earnings per share. Don't look at the ticker symbols, but look at the capital allocation decisions. You see, you are a stock picker. You are a partial owner of businesses that are available in the public markets, which means you are an owner. So why don't you look the business metrics as an owner? If you owned restaurants, you would look at how many customers, how much food you import, what is your cost per meal, what are the highest margins meals you have, what about the employees, how do you manage everything, what are your margins, what are your capital expenditures, all these things if you had your restaurants. Well, it's the same thing for stocks. If you own stock, you can look at the business, what it does, and stop judging whether the investment idea is good or not, depending on the last 3 months, 6 months. If you look at the stock price, it's not good. It will give you a lot of stress and anxiety. It's not good at all. It's better to focus on the per share metrics like revenue per share, EBIT per share, earnings per share, free cash flow per share, these kind of things. Having a Google Sheet instead of 12 monitors, you can manage your portfolio with the Google Sheet. Actually, I don't even have Excel in my Mac. I don't even use Excel. I don't have a complex software tool to track my investments. I sometimes use Google Sheet, and that's it. A simple tab can do all the work. You don't need to make things very complex. The same thing is true for DCFs, discount cash flow models. Sometimes I see people with a very complex valuation model, and from experience, I've seen the more simple the DCF, the better the idea. If you need a complex idea with a lot of models and a lot of adjustments, it's already too late. It's already wrong. Don't spend your precious time on ideas that are too complex, okay? Next point. 4, How boring builds wealth. Compounding is boring for one time until it isn't. Example, if you are a boring investor, you invest in boring companies, but this gets you a result of 15% per year. 15% annual returns, that's a 4x in 10 years. Most people never make it that far. Most people are not happy with 15% per year because their neighbors are making 50% per year with crypto. So you have FOMO and you want to try something else outside of your circle of competence. Always go back to your circle of competence. It will help you as a serious long-term investor. Okay? If you make 15% per year, life is good. Life is wonderful. It's a 4x in 10 years. If you can continue like this, it's wonderful. The best investors in the world are making 15-20% per year. So you are definitely in the top 10% of investors if you are generating these results on a long-term basis. The goal is, how do you make 15% on a long-term basis? And this is what I teach my clients. Case studies: Buffett, Terry Smith, Nick Sleep all had low turnover, high conviction, and no panic. Yeah, if you want boring investors, Warren Buffett is a good example. Terry Smith, same thing, and Nick Sleep. Not a lot of people know who Nick Sleep is, so let me do a quick recap. He's a UK-based investor, and with his friend Nick and Zach, they had a fund called the Nomad Partnership. I believe it was formed early 2000s. Yeah, between 2004 and 2014, 10 years, I believe, something like this. And they spotted Costco before everybody else. They spotted Amazon before everybody else. They spotted Berkshire Hathaway after the dot-com bubble. And they held high-quality businesses available at a good price. And this fund, for 10 years, they did a 10x. They multiplied their wealth by 10 in 10 years. It's a spectacular achievement they've done. And now they are retired, enjoying life. They have a foundation in the UK. You don't have many interviews. If you are curious, look on the internet who Nick Sleep is. It's very, very interesting. Fifth point, why most investors can't do it. And now that's maybe your problem. Maybe you are in this situation because you are victim of FOMO. FOMO, market noise, drama, tariffs, a tweet from Trump, some intervention in the Japanese market, Chinese market. Who remembers what happened in Japan in August 2024? The carry trade. Everybody was talking about the carry trade in 2024. In August, the markets dropped 5-10% in 1 or 2 days. It was crazy. Now, nobody cares at all. The sentiment in this market is changing a lot. So why would you spend your precious time on things that are irrelevant? You have this quote from Peter Lynch: if you spend 13 minutes on macro, you have lost 12 minutes of your life. Or something like this. It's a quote like this. Sorry if I misquote it, but you get my point. Don't spend any time looking at macro on Reddit, on forums. When they talk about macro, CNBC, TV will not help you at all. Wanting action leads to unnecessary trades and losses. How many people are in this situation? They have a portfolio that is working nicely, and they alter the portfolio. They change the portfolio because they want more. The more you do, the riskier it gets. So to all these people, you have a portfolio that actually works. Do more of what actually works. It's the same thing for the business, right? Investing is like, I see this similarly as my business, right? You check what works, you check what doesn't work, you check why, and you do what works, and you do more of what works. It's exactly the same for the stock market, right? For example, if you want the quick anecdote, I've tried many other social media stuff, Instagram, TikTok, LinkedIn, etc. And YouTube works. So why don't I just increase the volume in YouTube and stop all the rest? Well, now this is why you have daily videos. I just double down on things that are working. And you can do the same for your portfolio. You can double down on the type of companies that have outperformed already. Maybe you are a software engineer, so you know the tech area very well. And maybe you have made a fortune, very good trades with software companies. Do more of what works. Or maybe you are a real estate person. You own properties. You know how it works. You know the metrics that are working. And you have invested in good stocks, good home builders. And the stocks went up for many years. Metrics are fine. Do more. Do more of this. You are an expert in this industry. You continue like this. It's not that hard, actually. The hard part is the temptation to go elsewhere, to check elsewhere. The itch to do something is the enemy of wealth. Yeah, absolutely. Sixth point, how I help clients apply this. I have a coaching program and I help clients do the same, achieve 25% per year, having a portfolio that they are very proud of, their dream portfolio to outperform the market safely, without anxiety. We build simple long-term portfolios designed to beat the market. So it's based on fundamentals, not hype. And in this program, it includes support, mindset, accountability. We have calls every week. Most of my clients sleep better because they actually know what they're doing with their portfolio. They actually know the stocks they invest in, and they consider themselves as stock owners, business owners, right? Not speculators, owners. We look at businesses. This is why it's boring, but it works. So most of my clients, all of them actually, they sleep better, perform better, they have a better performance once they stop chasing performance. If you focus on the process, reducing your area of focus and just focusing solely on the things that are working for you, you increase your chance of outperforming the market. So yeah, a couple of points for you to help you keep things boring so that you can beat the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.